Well, thanks very much for joining us. We're delighted to be here for Beyond 2020 and a great conversation about impact investing and where we see it going in the next 5 years. I'm Oliver Libby. I'll be moderating and joining in the conversation today. The managing partner of HL Ventures and City Rock Venture Partners in New York, which has been doing impact investing with the nexus of growth, impact, and diversity for about 15 years now, based here in New York, but working with an international community on this very exciting topic. I'm joined today by two really extraordinary panelists who have a wealth of experience in this exciting space, Matilda Ho and Peter Hulbergs. And looking forward to hearing from them. I wanted to just begin here with a little brief introduction from each one, and then we'll dive into the conversation. So Matilda, would you kindly share with us a little bit of your background?
Yeah, thank you. This is Matilda. It's my great pleasure here today to share some of our initiatives and activities in the impact investment. So Bits and Bytes was founded in 2016, and we're China's pioneer agriculture and food tech VC. And our goal is to shape a more sustainable food future by investing in early stage tech startups to address sustainability challenges in the agri-food supply chain, from food security, food safety, human nutrition to protein production. And as of today, we already have 2 funds, and now we have invested in 16 different startups, both domestically and also internationally. And all these technology-driven startups were chosen is because how they can make a scalable impact and advance a more sustainable agri-food supply chain. So great to be here today.
Peter, go ahead.
Great, thanks, Oliver. Pleasure to be on today. Peter Hulbergs. I'm with Decarbonization Partners. That's a joint venture between BlackRock and Temasek, which really got off the ground over the course of this year. It was announced last April with a strong commitment from the 2 parent institutions. About $600 million has been committed, and we've been starting to invest as of earlier this year, and really focused across mobility, the built environment, and industry, and driving decarbonization. So helping companies scale that have technologically somewhat de-risked propositions and drive both returns and impact through scaling those in the market.
Well, thank you. That's great. And just for those who are joining us, I frequently am on panels like this, and there's a very narrow expertise here with the 3 of us. You have cross nations, cross sectors, cross investment stages. So I think we're going to have a really fun discussion about impact investing writ large. And with that in mind, I wanted to kick us off with a little bit of a definitional conversation. Impact investing means a lot to different people, a lot of different things to different people. And so Matilda, how do you think about defining impact investing these days?
Right. It's really difficult to define, in my opinion. I would say that, just take Bits and Bytes as example. Since day one, Bits and Bytes Fund was born with impact. And we do believe that every single investment decision that we make because it can address certain challenges under our investment strategy and create a more positive impact to the environment and to the people and to the society. I think ultimately what really probably set us apart from the majority of the generalist VC is that we do have a different intention. I think the intentionality is really what sets a impact investor or not. So we do identify and position ourselves as an impact investor. And even before, during, or after our investment process, we do have a framework and process designed to measure and continue to monitor the impact that we make through those investments. So that would be my personal take on it.
That makes good sense. And Peter, I'd love to hear the same from you, but also you bring a really fascinating perspective here because you are bringing an impact related fund and product to organizations that have been around for a lot longer than impact investing per se. So would love to hear your thoughts on also how you build in that culture and that approach to larger organizations.
Thanks, Oliver. And I really resonate with Matilda's answer there. I think the way, and clearly from my perspective here, we're really focused on decarbonization, so the avoidance or removal of emissions. into the atmosphere. And really we think of ourselves as a dual purpose fund. So there's truly the same commitment to measuring at the outset and estimating what the impact will be from a decarbonization perspective. And we look at that in parallel with clearly applying a returns lens. But really the reason why the returns are important also just circles right back to the impact, in the sense that the more economically successful our businesses are, because we only partner with companies that have an obvious decarbonization impact, that creates a virtuous circle, which is something that I personally very much believe in, and it's sort of probably has grown out of spending 10 years before this with Temasek, and that's a generational investor who thinks long term, and you need to think about sustainability at the core if you're going to be in the markets for generations.
I think you bring up a really interesting point here, which is the relationship between the impact lens and mission and returns. And from my perspective, having been in this for quite some time, I remind people frequently that impact is just an overlay on top of whatever you're investing in. So it can be deeply embedded, like it is, I think, of our organizations, but ultimately, you can have impact that's a 100% financial loss, which is philanthropy, and you can have impact that's a very high returns potentially if you're doing impact venture capital, and you can have impact that's got bond style returns and lower returns. So I think one of the things that I find is most often misconceived about impact is that it is one type of asset class with one type of return. Have you, Matilda, contended with that as you've built your firm, and in how people just assume that impact relates to returns?
Yeah, I think that concern exists all the time. And we like to say that we do also take purpose and profit equally important. And it shouldn't be an either or. It needs to check both boxes. And for us, the purpose represents the intention. There are so many agri-food tech founders out there. How will we find the founders that have very aligned mission that we can partner together in the long run? And profit is about the goal setting. How can we also support the founder to best achieve their goal, and so that they can scale up their impact? And by the end of the day, we're a fund. And it's our responsibility to also realize the maximized return for our LPs. So even when we are evaluating our success or our financial performance, we also benchmark against the best in class VCs on the IRR. We don't think that because of achieving a purpose, that means that we need to sacrifice profit. We think that is equally crucial for us.
Yeah, I think that's right. It's interesting, Peter, from my experience anyway, we started this, a long time ago, kind of on a defensive position of, we can do this without a concessionary return, as it's referred to. We can do this without losing money for investors or having an anemic financial performance. And I think now, at least for us, and I'm curious if Decarb is sensing the same thing, we can actually get on the offensive. We can say that a lot of these things, these sectors that we're interested in, climate and sustainability, of course, is one of them, have real tailwinds and are making financial sense for larger companies, for individuals, et cetera, as they make their decisions. So I think that stance of going from the defensive to the offensive here and making this case has been really impactful for us anyway.
Yeah. No, for sure. I think just to add in, I suppose it depends where in impact investing you're looking, but certainly in climate, where I spend all of my time, I think that the buy-in around the urgency and the scale of the opportunity set is very much there. So thankfully, actually, this issue that you referred to around the skepticism around concessionary returns and which is understandable where that would have come from. We haven't run into that so much lately. I think there's a lot of enthusiasm in light of, especially I sit in New York, so there's been really strong regulatory progress made over the course of the summer. So that, I think, has filled the market here with a sense of real momentum and opportunity, which is exciting. So that's sort of my perspective on that.
Yeah, and just staying with that thought, actually, obviously we've had some legislative actions here in the United States. Globally, there's been a lot of action. To me, it seems like there's an unusual relationship between impactful investing and thinking in a cross-sector kind of a way, where there's perhaps a deeper relationship between what we do and what, for example, government organizations are doing, or the nonprofit sector, and certainly thought leadership and media. Has that been your experience, Peter? And how have you been interacting across sectors?
Definitely. I think that so the way I would think about that is there's certainly a difference in sort of the landscape, depending on whether you're dealing with a lot of what I do sits quite deep in the energy sector. So dealing with B2B propositions versus other opportunities that are maybe a little bit closer to the consumer. So I think that momentum certainly varies depending on which industrial sector you deal with and the amount of regulatory scrutiny. I think the consumers are demanding increasing transparency, and so finding that real demand pull in those more consumer-facing parts. So this is things in the material space that are making exciting progress. So there's a ton of momentum that stems from that demand pull from the consumer, which has been translated into net zero commitments from corporates. And really, I find that that's a development that over the last few years has given us increased, further confidence to pursue this, because those net zero commitments are public, they're difficult, and the management teams are all really pushing hard to achieve them. And I think it's driving a degree of collaboration that hasn't been seen, at least in my 18 years of covering the space. It hasn't really been as collaborative as it is today.
Matilda, when you're thinking about, one of the things about the impact investing space is we're held responsible for measuring more than just financial performance. And obviously financial performance, the whole world of finance and asset management knows what an IRR is, and all the other key metrics of whether we're making money. Did you subscribe your fund to existing impact metrics? Did you design your own rubric? How do you think about measuring impact, and where do you think that that's going in the next 5 years? Do you see a consolidation and generalization of those things, or are we all kind of hunting by our own rules?
Yeah, I think unfortunately with that, there hasn't been established a commonly adopted framework to measure the impact and even hold the companies accountable for the same high standard. And not to mention, we're focusing on the early stage portfolio companies, which most of the investment are still in the pre-revenue stage. So for us, unfortunately, we do trade a lot of notes with other fund managers in the EU, in the US, even in Asia, but unfortunately, everyone is still required to set up their own framework and standard to set up their own. So at Bits and Bytes, we do need to create our own framework because in China, there's no such thing yet. And you also even see a lot of greenwashing after the President Xi's talk about the carbon neutrality goal. And all of a sudden, every single company is addressing carbon neutrality, no matter who you are and where you're from. So yeah, we do need to set up at the fund level and also at the portfolio level how we're going to assess the ESG risks. But since we are in the early stage, so we usually identify opportunity more than the risks. So we will sit down with the founder and then to think about your technology solution. How can that be able to reduce the carbon footprint compared to the current existing traditional solutions? And then we set the baseline, and then every year we come back and then measure the improvement. So since we're so small, and so early stage, the quantifiable impact doesn't really mean that much. However, the improvement, the relative improvement performance will be a very important measurement through our eyes.
Absolutely. Yeah, Peter, please jump in on this.
I don't like giving answers that just like agree with and say not much more than Matilda, because I think we're in exactly the same place. So as a joint venture, we've really been working hard on our frameworks and how do we articulate clearly and transparently what the, in our case, decarbonization impact is over the course of our whole period, and also, given a lot of the companies that we invest in also are scaling from a low base, we also show it, look at it further out. For the full fund, 10-year fund life, on a absolute thousands of metric tons basis and per annum, as well as per dollar deployed, what is the impact for a given opportunity, which gives you some sense of kind of bang for your buck, if you will. And then there's also the other complication that exists here is just around whether the impact is direct or indirect. So we do all we do is really think about that. We're a very mission-driven group that is excited about this. We show our work and we engage with the company that we're investing in, whether that's through life cycle analysis with external experts or just understanding how they frame the impact, and then really also engage with other funds as Matilda said, to see if there are best practices that we can, as an industry, share and develop. And I think driving a common language there, I think, will be really important for all of us.
Well, it's that last point I want to pick up on, just staying with this idea of metrics and measurement. Do we think, the title of this panel is will impact be the majority in 5 years? And I speaking as someone who's been in this for a long time, as you two both have as well, I feel like we're definitely on a very positive trend. But the question I have, based on what you just said, Peter, is can this really be a legitimate majority or generalized way that people invest? Will people have an ESG and impact lens on the majority of their assets until we can really cross compare in a simple and universally recognizable way in impact? And particularly, this is an unfair question for you, because your decarbonization, which is actually a metric I think can meet that standard, when we think about healthcare outcomes or financial inclusion, it becomes much harder. So do we think we can be the majority if we don't have generalized shared measurement?
I think the last part of your statement makes it really difficult. If we don't have generalized and standardized metrics, it becomes very difficult. I'm encouraged by some of the SEC progress that was made earlier this year around disclosure requirements here in the US, which will come in the next few years, and which will also filter through to private markets. So I do think we're trending in that direction, where I liked your initial description of it being an overlay, of that overlay becoming a useful metric for investors more broadly. So I do think we'll see the approach, the thought process, the methods that we're all developing becoming more commonly adopted by all investors.
And Matilda, you have a few different sectors that you invest in. Do you find it, as you kind of drill down in each one, that there's a different level of kind of shared metrics that are widely accepted in some areas that are harder than others to dial in?
Yeah, definitely. When we zooming into the early stage companies, we will definitely pay more attention on the E and then S and G. Because it would be almost impossible for them to already appoint a full-time chief sustainability officer in their Series A, or it would be very difficult to track their supply chain transparency if they haven't even set up their first industrial scale facility. So we definitely put more attention on the E side, and then trying to calculate if they continue to, let's say, a precision fermentation scale company, in every step in certain time horizon in the future, on an annual basis, how much GHG emission that they will be able to reduce. And so that will be the number that we're going to measure. And then on the other side, I wanted to share is that sometimes there is an infrastructure that is lacking. It's not just the technology itself. And so going back to the earlier stakeholder or ecosystem, that's why we oftentimes engage with a lot of different stakeholders to really push this impact much faster. So let's say cell-based meats, right? Now Singaporean government as well as the Netherlands already greenlight the cell culture meat to replace the traditional meat production. And we're still waiting for the FDA to grant the approval likely early next year. And so if the policy can also accelerate this direction, that will also help us to push forward those novel food to be pushed into the supermarket or in the restaurants. So policy is definitely the other way that we also trying to track in order for us to measure those impact on the novel food.
Totally. You know, I was just reflecting on something that's been interesting in our experience at HL Ventures, which is impact. It's something you said, Matilda, about kind of the time trajectory, the early stage, the later stage. For us, we find that the founders that we back obviously are very dedicated to impact, but it becomes hard, Peter, to the point you were making, in the very early stages, because the companies don't have the infrastructure, the measurement systems in place. They don't have, as Matilda, you said, a chief sustainability officer. It's a few people and an idea. So it's very hard to dedicate the time to building those impact systems early on. But then the other thing that happens is the other side. So it's like a barbell. In the middle part, where there's a little bit more resources, but maybe less pressure and attention, the company really locks into an impact strategy and measurement. And then as the company has raised more money and has more pressure, more shareholders, there's again this filtration in of the profit motive competing with the impact sometimes. And I think for us, and the question I have for you is how have you guided the founders and the teams that you've backed into that later stage when, you know, if you've raised money at a high valuation, there's a lot of pressure to generate that financial return. How do we keep the grounding of those teams in impact and support them in developing these systems we've been talking about? Either one.
Maybe I'll start. So in our internal assessment framework, the score number 5, meaning that they already had it or they already, achieved it. And the 4 is on their way to achieve it and they have the bandwidth to achieve it. And the 3 is that they don't have the bandwidth, but they're open and they have the commitment. When they have the right resources, then they will be able to adopt that improvement metrics. And so we use this framework as a tool for open communication as well. So we share the framework, all the metrics in front of them, and we have an open conversation that this is not to waste your time or waste your money, but this is to also help you to identify if you wanted to set up a long-term, valuable, mission-aligned company, you need to start thinking about the time for these components when the timing is right. But again, all the framework needs to be case by case because we can invest in the agri-machinery company or we can invest in a synthetic biology company. So we will then also prioritize out of these 15 components, what would be the top 3 or top 5 that we definitely need to increase the score or we need to improve, and maybe let's just work on that. So again, there's no right or wrong answer, but it does serve a tool for us to communicate with the founder, even with our employees. On our IC, we actually encourage our investment team members to have their own debate, and everyone can have very, very big difference on the score for the same company, even we're the same fund. So that just explains it's really, really difficult. That the score 3.8 or 3.9 probably doesn't really mean anything, but we really appreciate the time and the process and the content that we took the time to debate on what is more important and what is less.
Yeah, in my view, a lot of it comes down to culture at the end of the day. So I think the pressures, all of it that you describe, are very real on our businesses. And we spend a lot of time always have over the years, getting to know management teams. The sourcing process, therefore, takes a long time. I've always invested in a significant minority capacity, so we're not there to run their business, right? So I think the whole idea is finding those management teams that really have a commonality of vision with where we want to go, and if that's not there, during the diligence process, that can be a red flag and a completely fair reason to not proceed. So it's just to add to Matilda's answer. I think mine is just a slightly softer overlay as well, just around cultural fit, which will keep alignment in those moments that you described.
For sure. Now let me introduce a complicating factor, which is, and this panel does have kind of a time component over the next 5 years. Right now, we find ourselves, and I'm curious if you both do as well, on cap tables in companies where there are certain parts of the investor base that are very impact focused and really do believe the things that both of you just said. And then there might be some investors that are really not that interested in the impact side. We're still in the process where I think there's the transition ongoing. How, we just talked a little bit about how best to help founders stay close to the mission. How might we think about bringing some of our investment colleagues that aren't really with the impact program along when we're in the same companies?
I think we're finding a pretty collaborative space so far. So I think that it's, at the end of the day, it's a small industry, so folks all know each other and spend a lot of time. So I feel like building those relationships with your fellow investors that will show up on the cap tables, I think, is important, and it should be part of the same diligence process. At least as a slightly later stage investor, I'm often the new voice around the board table. So also choose very carefully which companies we get involved with based on who's already there. So I think there are actually not that many. There could hypothetically be investors who are just not aligned with us, and that would be an issue, but frankly, not something I've run into. I think, again, everyone is shifting gears to really see this as a tremendous opportunity ahead of us, and the scale of capital that's needed is so tremendous that there's plenty of room for a very collaborative ecosystem among the investors.
Yeah, I would say that it would be the same, because whoever who wants to invest in the agri-food tech, they know that this is a patient capital required. Each crop cycle could take 1 year, and breeding can take up to 8 to 10 years to be before they can commercialize to the market. So I think so far we aim to become the first institutional round investor, and we tend to lead with the board seat, so that we can have more influence on the company's governance after we invest in the company. So I would say that, yeah, so far we have been helping the company founders to bring the syndicate of the subsequent round of investors. So very luckily, we haven't really had any conflicts of the interest on the board level.
Yeah, well, that first of all, that's great. I wish we'd had the same experience. We've had certainly some fun conversations on boards. And look, I think that the trend is some of the more traditionally minded investors at least now understand that they have to introduce the impact component into the way that they're helping, discharge their fiduciary duties. But it still becomes a debate. And I think for folks who are joining us, it's not everyone will always be aligned here, but the world definitely is moving in a certain direction. My next question is actually related to that, which is, of course, we're all familiar with the statistics, and most of us, I think, on this panel invest in the private markets, but we've seen it in the public markets too, which is so many more assets are now managed according to ESG principles, right? I've seen as much as a third to a half of global asset bases are now tracking ESG. The question I have is maybe a little controversial, which is, to what extent do we buy that is actually happening? And what can we do as investors to promote the real impact versus some of the greenwashing that I think both of you mentioned earlier in the panel? What are some of the things that we can do to continue the trend of getting more assets under management via impact and ESG, but making sure that we're holding people to the high standards that they should be in executing a strategy like that. Matilda, have you run across that in your work in terms of kind of the greenwashing aspects of things?
Yeah, definitely. Actually, a lot. I would say that probably taking alternative protein as example, following the success of Beyond Meat's IPO, all of a sudden there are so many alternative protein startups popping on the ground, more than 100 over the last 2 years, and a lot of the investors from agri-food tech investors to CVCs to family offices to crossover investor all feel like they're fear of missing out, and they definitely wanted to invest in a company in this sector without really understanding that it takes time to build a very tasty and affordable meat analog. And so because of that, you can see that as of today, demand is still not proven anywhere, maybe except Europe. And so a lot of the capital just rushing in this sector, and then there's a lot of availability. But by the end of the day, consumers don't want to order those plant-based burgers in the restaurant. And if you look at the supermarket shelf, those products are not really moving, and people not coming back. And same in China or even Southeast Asia. So what does that mean? As a consequence, the investors all of a sudden decided to lose confidence in this sector, and they're saying that, oh, this is another Theranos scandal. So it's going to create a lot of harm for the industry. So these type of hype for us is definitely not good for the short term. And you see that Beyond Meat once hit a 10 billion market cap, and now they were declined by 80%, similarly to Oatly. And from our view, their current market cap it's probably a more realistic valuation of the company at this stage, and we're still in the very, very early stage of developing this product category that can replace the traditional animal production, and it takes time to educate consumers. And so we hope that for similar hypes will not continue to happen in this sector. But ultimately, you cannot avoid this type of cycle. So by the end of the day, 99% of those alternative meat startups will dry up, and then it might have some reshuffling or consolidation in this industry. And then only the truly innovators that really spend time enabling the taste, enabling the nutritional factor, enabling a more affordable price to the market will be here to stay. So ultimately, we need to be very careful for that greenwashing consequence.
I'm pretty sure my wife was about 10% of the Impossible Burger sales there for a minute, though. So, Peter, what do you think on this?
I'm a very optimistic person by nature, so I think that'll show through here in the sense that I do think we're seeing more transparency, and that trend will continue. So both from regulatory requirements, but also just technological advancements. I think the ability through software and sensors and just standardized reporting approaches, we will see more supply chain transparency, which will also allow investors to make their decisions and really, I think, in an informed fashion around the in my case, the climate impact of the companies they own. And I think the way you drive change is leading by example, so showing that we can make really, really good investments with tremendously important companies, and that will crowd in more capital. That's my fundamental belief.
Yeah, and look, you mentioned something in passing, Peter, earlier, which is, at least in the United States, the Securities and Exchange Commission is going to be passing some ESG rules. So I do think, some of the Wild West nature of the sector is going to start to, be under some stricter rules. They may or may not be completely right from the outset, but at least it's going to start to be that way. I want to double click on something really interesting that you said, Matilda, which is on the subject of kind of how in a sector or an approach that's as kind of hot as impact investing, you have these boom and bust cycles. Everyone gets really excited about clean tech when Barack Obama was elected in America. Then there's no cap and trade program, and the bottom falls out of the entire industry. But then it actually comes back because there are some consolidation, some really quality businesses. And so what I'm curious about, for me, the explanation for that has been that impact investing, whether it be in tiny startups or in larger publicly traded companies, has been a combination of breakthrough news-making innovations, new types of technology, new materials, and then some solid, quiet, stepwise progress on things like energy efficiency and how we finance these things. Some of the great breakthroughs, Peter, and I'm curious to get your thoughts on this, in the climate world and decarbonization were in the financing strategies behind solar power. That's what, the technology had to get to a point, and then once we figured out how to make them financial, it almost leached the solar industry of a lot of the politicization and all that, and just made it a smarter financial decision. In terms of the step of progress here, how do you think about balancing between those big breakthrough moments and then the kind of more stolid, quiet progress that we see moving things forward?
So I think Matilda, go ahead, or I'm happy to go first. Why don't I go first, just to give you a little bit of time? So I think from my perspective, we just look for pattern recognition. In effect, we saw solar and wind really, demonstrate that solid, steady progress that you describe, where across cycles, across economic and political cycles, costs continue to decline. So we like industries that have the potential to do the same. So in energy storage, I strongly believe you'll continue to see improvements there as we go, and that's kind of secular, irrespective of the prevailing political winds. I think there's really incredible talent coming out of universities pursuing continued improvement there. So and similarly, I'm excited about the carbon capture space for the same reason. I think some of the policy, at least here in the US, looks and feels quite a lot like what got the solar and wind industry to where it is today. So at some point, there's a virtuous flywheel effect where these sectors take off. So I think that helps get through the boom bust dynamics that you described.
Yeah, from our end, I would say that although the hard science is the infrastructure, but by the end of the day, we're investing in the team that can really bring the technology for commercialization. And that oftentimes it's evolutionary, not revolutionary, especially when it comes to adoption in the farm or change consumer demand or preferences. And so that's why we have a 10-year fund life. We know that we need to go through a few circles. So we like to say that we're patient. We respect that it will take at least 5 to 10 years for the technology solutions to be able to penetrate it into the end customers.
I think that makes a lot of sense. So, we're coming to a close here in just a little bit on this panel, and I'm very curious to see, now that we've had this wide-ranging and I think really exciting discussion, everything from, what is in the DNA of impact investing, cross-sector, boom bust cycles, the way we measure impact, the way we work with founders and other investors. As we take this all and distill it, what do you think is the 5-year trajectory of impact investing? Do we think that this broad approach, this lens, is going to continue in its popularity? Do we think that it will continue across sectors and investment styles? And perhaps what headwinds and tailwinds do you see in front of that? Matilda, let's start with you.
I would say that the headwind is still, especially if you operate in China, right? It's almost a crime to take it slow for everything. And so now you do see a lot of the company that are just, waving with the ESG flag because they know that there's a lot of the carbon neutrality funds that are ready to deploy money. And that would be something that I would be worried that still many people wanted to take advantage on those short-term window. But on the other side, I will say that long-term, I will still be very hopeful. Going back to the topic of this panel, will impact investment become mainstream? I do want to reframe that question into how soon can impact investment become mainstream. And I think that will depend on whether we can have more best case practices. I hope there will be more and more impact investment successful story to be listed, and everyone win-win-win. And more entrepreneurs, more and more investors see that doing good can also, ended up making us more money. Then more and more good money will flow in. Then that will be the day that I think, it will become a virtuous circle. And everyone will be internalized that when I make an investment decision, I also need to think about the environmental impact or social impact. I think hopefully in the next 5 years, there will be more and more listed company with attractive performance for people to follow.
Yeah, I would say, I suppose that might be true always, but the next 5 years feel extremely critical, just in terms of continuing the great progress that we've seen over the last few years. And I think in terms of situational awareness, the economic environment around us is extremely challenging. So I think as we all look and work with companies, thinking about runway, getting through to clear value creation milestones, I think is really important. And also building capabilities within companies that are focused. I find that given the macro environment is challenging, the financing kind of aspect of it becomes really important, continuing to keep cost of capital down in a market where equity isn't that cheap. So I think that means that especially for the more hard tech focused industries where tremendous amounts of CapEx are going to be needed to continue to drive toward net zero, I think that suddenly got a lot more complicated, I think. So that I see as one of the biggest challenges and opportunities over the next 5 years. If we get that right, it's going to be incredibly impactful period.
I totally agree. For me, I think this panel is one of the key things that will help. It's these big trends. They start with people and they start with organizations. And I know the audience here at Beyond is everything from investors to family offices to corporates. And it's in each person who's interested in this topic to continue to push this forward. And one of the most important things I think we can do, and we've talked a lot about it today, is to cut through some of the old myths. The idea that impact investing is a sector off in the corner, that it's concessionary, that you can't really make money or a lot of it. These things have really been disproven over the past 2 decades. And I think if we can continue to cut through those myths and reframe impact investing to what it really is, which is an overlay on top of all forms of investing. And that in fact, if you have the discipline to hold yourself to a standard as an investor, as a founder, as a manager at a large company, to some of the impactful things that we're looking for as a society now, be it climate outcomes, health, financial, et cetera, that will actually potentially lead to better performance and better returns. I think that's probably the key takeaway for me from this very interesting discussion. It's not something that's just going to happen automatically as a big trend. It's up to each person here, and that higher standard is really worth aspiring to. But I do think we have a bright future as impact investors over the next 5 years, and we're certainly holding the door open for everybody to come along. Matilda, Peter, thanks so much, and to the Beyond team for having us for this really interesting conversation. We hope that this has been helpful in situating impact investing for you all. And again, I think, I am, despite all the challenges that face the world, a hopeful person. I think my colleagues here are as well. This is an exciting time because we can use capital to make improvements for people and for the planet and to make life better. So with that, we'll send you on your way. Thank you so much, Beyond community, and we hope to see you next year.